Hey there, I wanted to record this video on the heels of our very exciting news this week, where we recently just announced that TD and BMO have approved Hosper Mortgage for a $50 million debt financing package. So, first of all, wanted to appreciate the team's efforts in reaching this milestone. In fact, this actually was a 5-year goal laid out for our team about 6 years ago. So better late than never. But wanted to share a bit more with you, our investors, our clients, our friends about what this means. This $50 million debt financing package means for TD as a business, but also what it means for you, our shareholders in our fund. So the first thing I would basically say is that this is not something revolutionary or proprietary. Every MIC that has grown to the point that we have is pursuing this. This is a natural part of the journey of a mortgage fund, where we bring in institutional investors to support the growth of our fund. So I suppose I would roll back and say, 4 years ago, we started working with TD Bank as our banking partner in the fund, but we ultimately had to move to RBC, who offered us our first line of credit. At that time, whole $750,000, which funded about 1 or 2 mortgages. But that was the start of us proving and building a track record. Ultimately, we left RBC to work with BMO, who we built a great relationship with, on the approval of a $15 million line of credit. Again, we continued to grow. We continued to take in more capital from our shareholders, and BMO then increased us to $25 million. Most recently, for the last 6 to 8 months, we've been working on a deal bringing TD back into the picture. So TD has joined forces with BMO, each providing $25 million of debt financing, which is today what has given us the $50 million line of credit that we can use for our fund. Now, I want to talk a bit about why we would do this. Of course, I've said in videos, I've said in many client conversations with clients about debt. Debt can be powerful. Debt can be very good. Debt can be scary. So I want to address just the positives that come with this debt, and also the risks that, of course, we need to mitigate when taking on some sort of leverage like this. So first, ultimately, the biggest reason that we're doing this and the biggest benefit this gives to our shareholders is additional liquidity. So operating a standalone MIC without any leverage is a pretty tricky proposition. If this year we fund $100 million of loans in the MIC, what happens next year if there's only $80 million of quality loans that get submitted to us? We have 3 options and none of them are good. Do we sit on the $20 million that we have that we don't have deals for? Of course, that's not possible because we're promised to pay a return on the full 100. So that would cause an issue there with uninvested capital. Do we return the $20 million to our shareholders? No fund manager wants to do that. And frankly, our investors wouldn't want that too. They've given us the money. They parked it with us to earn a return. Lastly, and probably most concerningly, a fund without any sort of flexibility or leverage might be forced to take deals to get that $20 million invested that might not otherwise meet the appetite of the fund. And that's where there's some risk in that gray space, that if you're a fund that has a certain amount of capital and you don't have that flexibility, you might feel consciously or subconsciously an obligation to get this money invested. And of course, that poses a risk, in a way, degrading the quality of the fund. Alternatively, in a position where we have the flexibility to have our loan portfolio fluctuate. Additionally, we have these 2 banking partners that have given us admittedly strict guidelines for the fund. I would say that the more we can do to build the best mortgage portfolio possible, the happier our banking partners are going to be. And ultimately, that directly benefits our shareholders as well. And at Hosper's business model, we love when there's an alignment of interests like that. So incentives become aligned between the manager, us, Hosper, the banks who have given us this financing, and our shareholders who benefit from prudent and strict guidelines for the fund. And also, leverage is a powerful tool when it comes to investing if used appropriately. So the type of leverage we're talking about is not, we're not taking 5 times leverage, 10 times leverage on the money we've invested. We're taking up to a maximum of 0.5 debt to 1 equity. And what that basically means is, at no point in time would debt ever equal more than 33% of the loan portfolio. And so this amount of responsible leverage will allow us to have that fluctuation, use leverage, and also effectively increase returns for our shareholders. So to explain clearly what I mean by that is, if and interest rates today might not be the interest rates a year from now, but I'll use rough today rates for an illustration. Imagine we can borrow from the bank at 7%, but we can charge borrowers 9%. And today we're paying our investors just over 9% in our balanced fund. Well, if a larger percentage of the borrowing is done at 7, now we have a surplus income that can be paid to the shareholders. So this effectively allows us to deliver higher returns, and especially in faced with a future of what we expect to be declining interest rates, this will be a way that we're able to maintain the returns that we've delivered, 8, 9, 10% in this elevated interest rate environment. We should be able to maintain those type of returns as the interest rate environment gets lower by using leverage responsibly. And so that's certainly another direct benefit from the leverage and from the debt financing. And then last but not least, this really helps us effectively do effective cash management. So if I think back to 4 years ago, before we had any material leverage, we did a successful raise. We've raised $3 million on June 1st from our clients. Well, that $3 million hits our account as a lump sum, and it immediately, we have an obligation to start paying our investors interest on that amount, whether we've got that invested or not. So there's always that scramble to get that money invested into deals. Now, we did build a practice of having a pipeline of deals ready to go, but it's still imperfect. Fast forward to today, where we have this line of credit, we can accept $3 million today, pay down the line of credit by noon, have it effectively not sitting idle because it's no longer borrowed. And then as we fund deals tomorrow and the next day and next week, we can then draw only the exact amount of funds that we need for that specific mortgage from the line of credit. So this is in a mortgage business, cash management is very important. And this really allows us to do cash management effectively, which obviously directly benefits our returns in the fund and keeps our costs low. So I think that's the sort of the high level that I'd want to share with you. Thank you so much for listening to this video, and thank you very much for your contribution so far to getting Hosper to this point in the journey. Be well.